Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, bringing to you for the first time ever an FR video debrief. So this is something which we are doing for the very first time. So forgive me if I am not being very clear in my explanations. Do give me an honest feedback about what you think about the way that I have explained in this video in the comment section. So let's get started. I'm going to be debriefing the very first case study in the FR Pre-March 2025 mock exam. So this is a question named as Therma Energy Company. So let us get started. Here is the case study in front of us, and here's the requirement that we're supposed to answer. So Therma Energy Company operates in the energy and environment solutions sector. Currently, the company is constructing large power plants for its customers. These contracts are long term in nature and take many years to complete. So now we know, because we are talking about long term contracts, this is going to be something relating to the revenue recognition, because how do you recognize the revenue when it's long term in nature? So Therma Energy has 3 contracts in progress at 31st December 20x4, all that have begun in the current year. The company uses the input method to account for profits on its power plant projects for all contracts. So this is the input method that we are supposed to be using. So before we head to the calculations, I would first like to draw you people towards the 2 types of methods that we can use for calculating how much project has been completed. So according to the concepts, there are 2 methods. First is known as the input method. Second one is known as the output method. So input and output. Input, as the name suggests, what all has been put into the contract, that is how you will measure. So let's suppose it's about raw materials, or it's about the cost of materials that we have incurred. So if you are measuring according to that, then it's going to be the input method. If you are doing your calculations according to the output, that means you have quoted a selling price of, let's suppose, 10,000, and you are measuring as to how much of your customer have you already billed. So that is going to be measurement according to the output method. So here we are supposed to use the input method. That means we are going to base our calculations on the costs which have been incurred and the total cost which is going to be incurred to complete the project. So first requirement is, how should the contract asset or liability be recorded in the statement of financial position of Therma Energy Company for contract 1 in accordance with IFRS 15, revenue from contracts with customers. So here there are 3 contracts of which we have the information. We are going to talk about the first contract that is there with us. So the first contract, you have the contract price. This represents the amount of money that you're going to charge from the customer. So this is the selling price for your contract 1. Selling price is 12,500. Now contract cost to date, that means till date you have spent, cost spent is equal to 8,000, and you are anticipating that to complete cost to complete is still going to take 2,000 more. So that means, according to your estimates, the total cost is going to be 8 plus 2, which is 10,000. So 10,000 is the total cost. So with this we can work out the completion percentage. So the completion percentage is going to be, because this is the input method, how much have I spent so far? I have spent 8,000. And how much do I intend to spend? A total of 10,000. That means my project is how much? It's 80% complete. You can multiply this by 100, so you'll get your answer in percentage. So that means your project is 80% complete. Now, how much have you charged your customer? Your basically, according to the revenue recognition, if your project is 80% complete of your selling price, you should have billed your customer 80% of selling price. So our selling price is 12,500. So 80% of 12,500. Work that out. How much does that come out to be? 12,500 into 0.8 gives you 10,000. So that means you should have billed your customer $10,000. And how much have you billed your customer already? It's written that here you have billed your customer 11,000 already. So that means you have billed 1,000 extra. So that means this is going to be a liability. Whenever you've taken more money than you should have, that is something which you have not really earned but you have received. So then it's a liability. So it's $1,000 of contract liability. Heading forward to the next question. This question wants you to talk about what amount of revenue should be recognized in the statement of profit and loss of Therma Energy Company for contract 2 in accordance with IFRS 15. So now we are going to be dealing with contract 2 over here. Contract 2 says the contract price is 15,000. You have incurred 9,000. You intend to incur 9,000 more. So the total cost according to us, total cost is going to be for contract 2, 9,000 we have already spent plus 9,000 is still to be spent. So that means your total cost is $18,000. Now 18,000 is what you have spent and 9,000 you have spent already. So how do you work out your completion percentage? Completion percentage is going to be 9,000. That means you have spent 9,000 and versus total you want to spend 18,000 into 100. This is going to give you 50% as the completion. So how much revenue should you recognize? 50% of what the selling price has been decided. So the selling price is given to us right over here, 15,000, and out of this we are supposed to take 50%. So 50% into 15,000. So this is going to give you 7,500. So 3 zeros are already there here also and 3 zeros are there here also. So I just need to divide 15,000 by 2, or you can say multiplied by 50%, one and the same thing. This will give you an answer of 7,500. Now moving ahead to the next question. Here we are going to talk about contract 3. So in relation to contract 3, what amounts should appear in the statement of financial position of Therma Energy Company as at 31st December 20x4 as per IFRS 15 revenue from contract with customers and IAS 37 provisions, contingent assets and contingent liabilities. So that means you have to comply with not one but two IAS and IFRS over here. So let's see about contract 3 now. Contract 3, the price is 11,500 and we are supposed to spend 6,000 more. 6,000 we have spent. So that means again you will find a 50% completion. Why? The total cost total is going to be 6,000 that you have incurred till date and 6,000 that will still take. So that makes your cost total as 12,000. Now if you want to work out the completion percentage, here you're going to take whatever you've spent. So you've spent 6,000 so far and the total that you're going to spend on this contract is 12,000. So 6,000 divided by 12,000 into 100, that gives you 50% as the completion percentage. So that means 50% of selling price is what your revenue should be. So your revenue is going to be 50% multiplied by 11,500. So if you multiply 11,500 with 50%, you're going to get 5750. 5750. So this is what you should have billed to your customer. And how much have you actually billed? You have only billed $5,500 to your customer. So that means you should have billed less, but you have billed that means you should have billed more and you've actually billed a lesser amount. So by how much is your amount lesser? You have billed 5,500 but you are due to take 5,700. So 250 more you have to take from the customer. If you have earned the money and you're still yet to receive it, then it becomes your asset. So $250,000 of contract asset needs to be recognized. This is something that we observe in option 1 as well as option 4. Now we will have to decide whether the provision is going to be 500,000 or 250,000, so that we are able to decide our final answer. So now we will talk about the provision part of it. Now let's see, for the provision, we will have to see if we are making a profit or a gain, profit or a loss in this contract. So as we have found out, the total cost for this project, contract 3, is going to be $12,000. And how much is the selling price? It's only 11,500. So that means if we are incurring a cost of 12,000, cost is of 12,000, selling price is of 11,500. That means we are 500 short. That means we have a loss of 500,000. Now out of, if you talk about the year, whenever IS 37 is applicable, whatever loss you are supposed to be making in the future, you have to recognize all in today's time. But what happens to the remainder of the loss? The remainder of the loss that we have, first of all, we are making a loss of 500,000. Now this contract is halfway complete in this year itself. That means we are going to book half of the loss in this year itself. So how much loss we are going to make in the future? If we are booking 250 of loss, 500's half is 250. So if we are booking 250 of loss in this year, that means 250 of loss will be held whenever we complete the project over the entire course. So that means we have to make a provision of 250. So here your final answer is going to be, you have a contract asset of 250,000 and a provision of $250,000. So now we move ahead to question number 19. Here you are supposed to say whether the statements are true or false. So the very first, let's read about the scenario. Therma Energy's accountant is unsure about how to account for the sale and repurchase agreements. You have to identify whether the following statements are true or false as per IFRS 15. So the very first statement says, if the repurchase price is lesser than the original selling price. So before we head to solving this kind of a question, I would quickly like you people to recap what you have learned in this concept. So according to the IFRS 15 chapter that you would have studied, this is chapter number 5 from your study hub. So according to this chapter, it's going to be classified as a lease in the scenario where the repurchase price is going to be less. Repurchase price is going to be less than the original selling price. Then it becomes a lease. And if it is the other way around, then you call it the financing arrangement. When is it called a financing arrangement? It is when the repurchase is greater than or equal to your original selling price. So let's see what the situation is talking about, and then accordingly we are going to mark it true or false. So the very first statement says, if the repurchase price is lesser than the original selling price, it is a lease. And according to the statement, the entity must account for the repurchase contract as a financing arrangement. When is it a financing arrangement? When it is more or equal to. So that means this statement is false. Moving to the second statement, if the customer is unlikely to exercise the right of obligating the company to repurchase the asset, the entity accounts for the contract as if it is a normal sale with a right of return. Now this statement is absolutely true. Why? If the customer is not going to come back to us to repurchase the asset, then we are going to hold it as a contract as if it is a normal sale with a right of return. So this statement is absolutely true. Moving ahead to the last statement, Therma Energy is contemplating to change the way they measure the progress towards the completion of contracts. The company would now like to adopt the output method based on surveyors' reports instead of the existing input method. So they are changing the method that they follow. From input they want to move to the output method. So we have to tell whether it's a change in accounting policy or an estimate, and whether it will be applied retrospectively or prospectively. So for this we will again revise our concepts. The concepts that you people would have learnt with respect to policy or an estimate is, if you are deciding about the policy is always going to be a choice. So this could mean a specific accounting method like FIFO, LIFO, whenever it comes to depreciation, straight line or WDV. So policy is about a choice. And whenever you talk about estimate is always going to be a calculation. Calculation means how do you value the asset? How do you find out the useful life of a machine for the depreciation? So all of these are estimates. Another very good example of how you will always remember the difference between policy and estimate is whenever you're talking about the investments. So let's suppose for my investments, I am choosing the fair value method to value my investments. So this is going to be an example of policy. Now I have decided as a policy that I will use fair value method for the valuation of my investments. Now if I am going to determine the current fair market value of those investments based on the market data, that is an estimate, that is a calculation. So estimate example would be determining market value, current market value based on market data. So because market data is also going to be something which I use to find out the market value, it's only going to be an estimate, not a very sure figure. So that is why we call it an estimate. Now, whenever you talk about prospective and retrospective, first of all, if you people are not aware, prospective means that it is going to be applied from current and the future. I will write it down for you. Prospective means current and future. So if you're changing something, you will change now and what you do in the future. Whereas if it is retrospective is applicable to everything, past, present as well as future. So here you will talk about past, present and also the future. So that means this is the difference between prospective and retrospective. So whenever you're doing a change in policy, policies are usually changed retrospectively. And whenever you talk about estimate is usually going to be changed prospectively. So this is how I have revised the concept for you. Now we will answer this question. So here we are making a choice between how we are finding the estimate of something. Hence it is going to be a change in accounting estimate. And how do estimates change? Estimates are always changing prospectively. So we will choose the option which says that it is an estimate. It is a change in your accounting estimate and it is going to be applied prospectively. That means it's going to be applicable for now, for the present as well as the future. So this is the video debrief for your Therma Energy Company very first section B case study from your FR Pre-March 2025 mock exam. Do let me know if you want me to create the debrief videos of the other questions also. All the very best for your exams. Thank you.